Late at night, the crypto market's glow turns almost magnetic, pulling traders into its vortex. Every price tick feels like a jolt through the system. It should be a rational game, but the data betray us. A Chainplay survey of 1,000 crypto investors found that fully 92% admit their buy-sell decisions are guided by emotion, not cold analysis. I feel that truth every time I hesitate on a trade. The promise of logic is outpaced by primal fear and greed. This psychological grip on crypto is well documented. Investopedia bluntly notes that investing based on emotion, greed, or fear is the main reason so many people buy at market tops and sell at bottoms. In practice, I see it all the time. If a meme coin doubles overnight, greed makes me scramble to buy more. And when it tanks, fear makes me sell, often right at the worst moment. Chainplay's survey even quantifies the common triggers. 31% of investors said a rapid price surge sets off their emotions. 21.7% point to surging trading volume. And 14.6% blame media headlines. It's like walking a tightrope between euphoria and panic. And nearly everyone stumbles. Yet amid that chaos, there are opportunities that patient traders can exploit. Take September 2025, for example. The crypto market had a brutal reckoning when over $1.5 billion in leveraged positions were liquidated in a single day, as Bitcoin, Ethereum, and Dogecoin all swooned on cascading margin calls. Headlines blared liquidations and investors panicked, selling everything. But a contrarian view reveals the other side. At its lows, Bitcoin was actually only down about 3%, to below $112,000. Thanks to roughly $524 million in new inflows from institutional Bitcoin ETFs that very day. In fact, Bitcoin still sat near a 77% year-to-date gain. That tells me that during market turmoil, the institutional smart money was quietly buying. While retail sentiment was at extreme fear, the fundamentals hadn't disappeared. Experienced traders saw the dip as a temporary shakeout and a chance to add at a discount. Fundamentals do matter, and watching them can separate noise from truth. In that same September 2025 crash, Ethereum dropped about 9% down to $4,075, putting roughly $8.8 billion of longs at risk of liquidation. News reports made it sound apocalyptic. But savvy traders remembered something crucial. Ethereum had just completed its DENCON upgrade, which reduced transaction fees for the network. That upgrade actually makes Ethereum more useful in the long run. The short-term plunge was just a technical hiccup from heavy liquidations, not a sign that the blockchain was broken. Chainplay's analysis underscores this kind of thinking. Focus on a coin's utility and fundamentals rather than every wild price swing. When I step back, I see that the DENCON event, while causing a momentary panic, was fundamentally a positive. So I try to tune out the panic and remember the bigger picture. Did anything really change about how valuable the asset is? The crypto market's non-stop nature only amplifies these swings. Unlike stocks, crypto trades 24/7. A tweet or a flash news at 2 a.m. can trigger price moves seconds later. For example, on the 26th of September 2025, the Crypto Fear and Greed Index plunged to 28 firmly into extreme fear territory. That kind of reading means most investors have already capitulated and are terrified. Every minute, social media algorithms feed the latest hype or news, and many traders react immediately. In such an environment, the market's temperature can swing wildly from one day to the next. When fear hits panic levels, it usually means one thing: a recovery is often coming, because long-term players start bottom fishing. Of course, the other side of this pendulum is euphoric mania. Every crypto bull run has its tales of everyday folks becoming overnight millionaires. The moment a meme coin moons, legions of traders jump in, almost reflexively. It feels like magic, until it vanishes. History has savage lessons. Recall May 2022. The so-called Terra Luna stablecoin collapsed in 3 days. 1 week, the Luna token had been a top 10 cryptocurrency. The next week, it was effectively worthless, taking tens of billions with it. The collapse was quick and brutal, propelled by emotional investing and blind faith in the project. Stories like that are reminders that hype-built castles can crumble overnight. Emotional trading also quietly drains confidence. In bull runs, you might buy in the final minutes because everyone else is, only to watch prices slump later. In bear markets, you might stubbornly HODLA falling coin out of pride, missing the chance to cut losses. Chainplay identifies this as the holding period paradox. 87.6% of surveyed traders claimed they invested for the long term, yet 66.6% of them sold their crypto within 1 year. That gap shows how our actions betray our plans. We imagine ourselves as rational long-term investors, but when volatility hits, emotion often triggers premature exits. I see this in myself. Conviction on Monday can turn to panic by Wednesday if the charts bleed. It's no mystery why we fall into these traps. Human psychology is wired to panic or get greedy. There's the classic fear of missing out, FOMO. When prices surge, not joining the party feels like a personal failure. Conversely, loss aversion kicks in when prices drop. The pain of loss hurts more than the pleasure of an equal gain. Our brains literally scream at us to sell and avoid further losses. Social proof amplifies it. If 50 influencers tweet to the moon, it tugs at the heartstrings. In a way, the market's mood swings are a mirror of our own reptilian instincts. It's no wonder rationality often blurs in the moment. Yet emotional investing is not destiny. There are tools and habits to fight back. For one, dollar-cost averaging DCA is a simple strategy many of us use. Instead of going all-in at once, we split our buy into regular intervals, smoothing out the peaks and valleys. Investopedia and many analysts emphasize DCA and diversification as antidotes to emotional swings. In practice, when I shift to a DCA mindset, I feel calmer. I don't have to pick the perfect bottom. And by spreading my holdings across several assets, instead of betting everything on one coin, a crash in one position hurts less. Another way to keep panic at bay. I tell myself that if I bought a crypto for strong reasons, tech, adoption, use cases, minor dips shouldn't shake my conviction as long as those reasons remain. Some traders even force discipline with checklists and rules. For example, I might jot down my motivation for a trade before I make it. If I later bail out, I can review whether it was a calculated decision or just fear. Others set hard stop-loss orders so they don't make a gut call in the heat of the moment. Keeping a trading journal is a disciplined trick. It's hard to justify an emotional exit when you promised yourself on paper to hold. Basically, we try to make our habits follow logic instead of letting our impulses drive the wheel. Meanwhile, something interesting is happening in the background. The crypto arena is getting more mature. Big institutions and funds are wading in with longer-term horizons, not just speculators chasing quick pumps. This change brings more stability and analysis to the game. For instance, in late 2025, new regulated Bitcoin ETFs launched by BlackRock and Grayscale were soaking up roughly $500 million per day in inflows. When institutional money chases crypto, they typically assess fundamentals more rigorously. Even analysts at big banks are taking crypto seriously now. Standard Chartered and Bitwise recently published price forecasts suggesting Bitcoin could reach around $200,000 by year-end, citing supply shocks like the upcoming halving and growing adoption. That doesn't mean markets can't still swoon, but it does underline that the narrative is shifting toward long-term value, not just memes. Watching those flows and forecasts gives me a counterbalance to the Reddit frenzy narratives, of course. Not everyone waits for fundamentals. Some contrarian traders see every crash as a chance to load up. Crypto lore is full of dark humor. One tweet I remember read, "Every crypto bro I've met has some gut-wrenching love story in their past. Turns out heartbreak builds the best portfolios." In other words, it jokes that everyone who makes it in crypto started with a crushing loss. It's grim humor, but it highlights a truth. Often the biggest gains do come to those who survive a few storms. Still, jokes aside, that's not a strategy. It's a narrative traders cling to when the market goes against them. The real path forward lies in awareness. The next time I feel an urgent itch to click buy or sell, I pause and ask, what am I really reacting to? Is it a meaningful development in the project or just another headline? I try to answer, has anything fundamental changed in my assets outlook? If not, then what feels like a crisis might just be noise. I tell myself to trust the analysis I did before the ride got bumpy. 24/7's crypto news will always peddle urgency. But I remind myself, the market will be here tomorrow, and a reason to sell today might vanish by Monday. In the end, the mystery of emotional crypto trading isn't mystical at all. It's human. The ups and downs on the price charts reflect our own highs and lows. Each spike and crash writes a chapter of a bigger story, one where fear and greed duel with logic. The very volatility that can ruin an undisciplined trader is also what makes crypto enticing. It's why this market attracts rebels, streamers, and risk-takers in the first place. By acknowledging both the risk of panic and the potential reward of patience, I try to shape a narrative where emotion is a factor but not the author. As the charts flicker past, I make a conscious choice. Each trade will will be a calculated move in this grand, unpredictable novel of markets, not just a knee-jerk reaction to the latest plot twist,